I thought this would be a great time to do a video about what I've learned from investing in bear markets, in many bear markets. And if you're watching my channel, you've probably invested through bear markets and experienced bear markets. But we tend to forget what we learn when things are not in our recent memory. We think what's happened lately is what will keep happening, and we also just sort of forget. We forget certainly the intensity of the awarenesses, the knowledge, and the feelings that we experience when we go through those bear markets. So I've learned some really, really great lessons from investing in bear markets. I like to say that lessons, the mistakes are really just lessons that help us do better next time. And life, I think, certainly investing is a series of learning and growing and becoming better as investors. So in this video, I'm going to share with you what I have learned in past bear markets that really, really stand out. Hi, I'm Camille Gaines here and on my website, retirecertain.com. I write about and talk about investing and about income streams, about retirement. If this interests you, you might want to subscribe to my channel, click that little thumbs up so that you see my new videos in your feed. The very first bear market that I really remember investing through was the bear market of 1987. I vividly recall that bear market because it dropped. The S&P 500 dropped so suddenly, 500 points, which was in those days a really, really big deal in just one day. That year, I had actually moved to Bermuda for my husband's job, and I was flying, and I landed, and we had that bear market that just boom, it was there all of a sudden. And what I really, really learned from that bear market was that things can change really, really quickly, both for the good and for the bad. So the bear market was just boom, it was there, it was hard and fast. But then the bear market ended in only a few months. It felt like it would last for a long time, that it was much worse than it was. But we quickly got out of that bear market. It ended, and that's what I really learned from that bear market, is that bear markets can happen quickly, they can come on very, very suddenly, but then they can also end very suddenly as well. That wasn't always the case, as you probably know, with the next bear markets. Then let's go forward to the next bear market, which was from the tech bust of the early 2000s. Wow, this was very intense because so many people felt like with the birth of the internet, everything would change, and it did change so many things. But that's what I learned from this bear market, one of the things, and that was that when we have these huge disruptors that investors think are going to change everything and it will never be the same, and we've got to completely redo our portfolios and invest in NASDAQ stocks, which the NASDAQ dropped about over 72%. Some stats I've seen are as high as 78% in that tech bust. So everybody was loaded up in NASDAQ stocks because everyone was so caught up in the growth of the internet. And what I learned was, number one, to always have a diversified portfolio. Don't buy into hype. But I also learned that yes, changes are happening. Big changes can happen, but they may not happen immediately. They may take years to happen. And this internet birth that everyone was all excited about and expecting immediately, that led to the tech bust, has played itself out over the past 2 decades, and we're still continuing to see it play out. So yes, the change is happening, but do we need to change our investments entirely this year because this huge change is happening? Well, probably not. In this situation, that was not the case. And many companies went broke because of the tech bust. I live in Austin. Austin is a fairly tech-heavy economy, and I saw friends lose their jobs and their livelihood just like that. So it can happen really quickly. So that's what I learned from that particular bear market. Let me take a quick look at my notes and make sure I mentioned everything I wanted to mention about that. Oh, the next one is we can have back-to-back bear markets, because we had the tech bust bear market, but then there were two bear markets back-to-back in that period from 2001 through 2003. So we feel like when we go through a really bad bear market like we saw in the tech bust, that it will be a while before we have another one, but that's not always the case. And then that's the perfect segue into the next bear market. And what I learned from this, many things, but one thing was that we can still have another bear market shortly after previous bear markets. Remember, we had the horrible tech bust, and then the 2007, 8, 9 bear market rolled in shortly thereafter. So I think we tend to think that it will be years before we have another bear market, like I was just saying, but this happened 3 times where we had these 3 bear markets in this one decade. All right, so what else I learned from the bear market? Things can keep getting worse for a while. We've seen really sweet little bear markets in the last 2 bear markets that we've experienced in the 2010 to 2020 decade. In fact, one of those bear markets barely even qualifies for a bear market. But even the 2020 bear market, they were very fast. Bear markets, though, that are really serious, severe bear markets, secular bear markets, can be really, things get worse before they get better. And I think that people have gotten spoiled, investors have gotten spoiled with buying the dips and just thinking, oh, it's going to get better. But that doesn't always happen. Sometimes it gets a lot worse before it gets better. And we get caught in bear traps along the way where the market drops, it comes back up, and investors go, oh, okay, it's okay to get back in, or put more money in or buy the dip or whatever. And then the bear market drops again, and investors often will load up along the way down. It's often said that the smart money exits first, and the retail investors such as ourselves are the ones that really end up with the most pain during bear markets. All right, the other things about the 2008 bear market is that I learned this in both the technology bust bear market and again in the 2008 bear market. Even though I've bought my first fund, you may have heard me say here in my early 20s, that was a really long time ago, I was also using financial advisors during the 2000s decade. And what I learned from this is that just because I'm using a financial advisor, that doesn't mean my investments will go down. Won't go down. I used to think that if I used a financial advisor, they knew something special or different or better than what I knew. And granted, they do. They have their areas of expertise. Absolutely. I'm not saying they don't. But I made the erroneous assumption that if I was using a financial advisor, my assets, my investments would not go down any more so than, or they just wouldn't go down, period. And I would be better off than investing myself in those same assets. And that just wasn't the case. I thought the advisors would get me out of the market, and that is just not a valid assumption at all. In fact, most financial advisors are buy and hold financial advisors. They don't buy and sell. They may rotate a little bit, but most of them don't, and many of them hold firm to the asset allocation even during bear markets. So that was a bit of a lesson for me. Then another thing I learned is that the housing market really slows due to buyer uncertainty. As of this recording, we're starting to really see that again now. I was looking at my feed today. I love to look at real estate. And I was looking at real estate today and I was shocked by the number of new listings. It used to be there weren't many new listings and it was just one after the other with the red tag. New listing and also price dropped and open house. Homes haven't had to have open houses in so many years in Austin, Texas. There were bidding wars. As soon as the house went on the market, it was gone. You were lucky if you got a bid in. Now open houses, lower prices. So housing markets really slow when there are bear markets because of buyer uncertainty. The next thing that I learned is the more expensive homes are really hard to move. I had friends that had come to Austin in the technology space that were C-level executives, and they had really large homes, and certainly the homes that were over $1 million, $2 million, $3 million, they just become really hard to move during hard economic times and during bear markets because people's net worth drops. Then the next thing that I learned a lot from the 2008 bear market, I really did. And that was to always be prepared for a bear market. Again, we had those 3 bear markets in the 2000s decade, but just to always be prepared, not make assumptions that, because I had this much money placed with a financial advisor, or because this, or because that. It's always be prepared for bear market. What does that look like? Well, that's what I really talk about here on this channel a lot, and that is just having assets that increase, that are non-correlated with stocks when bear markets are imminent, when bear markets are brewing, when we see that it's time to do that. I'm not a buy and hold investor, as you may have heard me say here before. That's not what I do. I think that sometimes there are opportunities and sometimes there are higher risks because assets become undervalued and they become overvalued, and that's just how I invest. It's kind of a core financial principle that we buy assets for as cheap as we can, and I don't see that happening with buy and hold investing. So having said that, I think it's important to always be prepared for bear markets, and one way to be prepared for bear markets is to have extra cash because, well, number one, your losses are more contained, but also simply because my next point that I really learned from this bear market is that there are incredible bargains after bear markets in most all assets, especially in real estate and in stocks, and that can completely change your financial future. So if you work a bear market right, you can really come out ahead because you can significantly increase the value of your portfolio if you have that capital to buy assets when they are super cheap. And it's the same companies that are selling, and yes, granted, most of them, their sales have slowed down because of the recession, but if the fundamentals of the company haven't changed, they're secure companies, they make sense, they're financially sound, they're going to come back most of the time, depending on the industry, of course, that it's not an industry that is no longer needed in our ever and rapidly changing world, right? And that does happen a lot. All right, and the other thing that I wanted to mention about the 2008 bear market was that economic cycles determine our investment returns, and that's because economic cycles determine market cycles, and market cycles determine our investment returns. It's not picking the right fund. It's not an ETF versus a mutual fund or this financial advisor, that financial advisor. That could have an influence, but more often it is because factors completely outside our control determine our investment returns. Not choosing the right stock, choosing the right fund, choosing the right advisor, choosing the right product. It's because these things outside our control, that's what determines our investment returns. And that makes so much sense. I learned that from seeing the way my father invested when he purchased municipal bond funds that were paying interest tax-free up to 25% at very, very steep discounts. That was my sort of introduction, or the thing that stuck with me about investing. And that is because of the economic cycle. That's because the interest rate cycle at the time, interest rates were very, very high, and there was a lot of risk. There was a lot of fear. So that's what drives our investment returns. That's why I like to invest based on opportunities, and I guess what probably keeps me away from being really a long-term investor. Having said that, in certain assets, I absolutely am a long-term investor, and that would be in our rental properties, in our home, and even in our online businesses. Remember, retire certain.